In August of 1976, Jack Bogle tried to raise $150 million to launch a new kind of investment fund. He raised just over $11 million. Wall Street didn't call it a modest start. They called it Bogle's folly. One rival firm reportedly told its own sales force not to sell it because a fund that simply matched the market instead of trying to beat it was, in their words, un-American. That folly is now the ancestor of index funds, holding trillions of dollars for tens of millions of ordinary investors. And the man who built it spent the next 2 decades being told repeatedly and confidently that he was wrong. Here's why this matters more than a retirement account balance. Before 1976, if you wanted to invest in the stock market without personally picking stocks, your only real option was to pay a professional fund manager to pick them for you, and pay them whether they beat the market or not. Bogle's idea broke that entire premise. Instead of paying someone to try to outsmart the market, you could simply own the market, every major company in it, in proportion for a fraction of the cost. And statistically, over time, do better than most of the professionals charging you to try to beat it. Today, index funds and low-cost strategy behind them influence how most retirement money in America is invested, whether people realize it or not. This is the story of how an idea mocked as a joke became the default setting for how ordinary people build wealth. The idea that became the index fund didn't start in a boardroom. It started 25 years earlier in a college dorm room as a senior thesis nobody outside Princeton would read for decades. In 1951, a young economics student named Jack Bogle wrote his undergraduate thesis on the mutual fund industry. Buried in that thesis was an observation that would define his entire career. Costs matter. Not returns before costs, returns after costs, which is the only number an investor actually keeps. Mutual funds at the time charged sales commissions, management fees, and racked up hidden trading costs. And Bogle noticed that these costs quietly ate into what investors actually took home, year after year, regardless of how skilled the fund manager claimed to be. That thesis got him a job at the Philadelphia investment firm called Wellington Management. He spent the next 2 decades climbing the ranks, and in 1974, he was fired as its CEO following a merger that he had approved. It went badly and cost him the board's confidence. By his own account, he wasn't discouraged. He simply started over, founding a new company, the Vanguard Group. Vanguard wasn't built like other fund companies, and that structural choice is the reason the index fund experiment was even possible. Bogle set Vanguard up so that the funds themselves would actually own the management company, meaning Vanguard wasn't answering to outside shareholders demanding profit margins. It was functionally owned by its own investors. This mattered enormously for what came next, because Bogle was about to propose something that made no sense if your goal was to maximize fees. The idea itself on paper was almost insultingly simple. Instead of hiring analysts and managers to pick winning stocks, build a fund that just buys all 500 companies in the S&P 500 in the same proportion as the index itself and does essentially no trading, no stock picking, no timing the market, no trying to be clever. This wasn't entirely Bogle's own invention in isolation. Economists like Paul Samuelson had publicly challenging the industry to create exactly this kind of product, and Princeton professor Burton Malkiel had made a similar case in his own writing around the same time. But proposing the idea in an academic paper and actually building it, funding it, and selling it to the public are very different things. Bogle was the one who actually tried to launch it. In 1976, Vanguard brought the first index investment trust to market, the fund that would later become the Vanguard 500 Index. It was, by Bogle's own later description, an abject failure at launch, raising a little over $11 million against a hoped-for range of $50 to $150 million. Wall Street's reaction wasn't quite skepticism, it was open mockery. Rival firms nicknamed it Bogle's Folly, the pitch. Pay us less and try to do no better than average ran directly against how the entire industry sold itself, which was built on the promise that skilled managers could beat the market and were worth paying extra for. For the better part of 2 decades, index stayed a niche, often ridiculed strategy. Actively managed funds still dominated the industry, and being told your fund was designed to be average was, for the most of Wall Street's history, close to an insult. But the fund kept doing something stubborn and unglamorous. Over long stretches of time, after accounting for the fees active funds charged, the boring index fund quietly outperformed a majority of professionally managed funds trying to beat it. Not every year, not spectacularly, just consistently, compounded over decades, which turns out to be exactly the time frame that matters most for a retirement account. Slowly, the results became harder to dismiss. Academic research piled up supporting the same conclusion Bogle's 1951 thesis had already suggested. Costs are one of the few things an investor can actually control, and lower costs compound into meaningfully better outcomes over a lifetime. Here's the part of the story that tends to get lost once quote-unquote index funds won. The very rivals who mocked the idea eventually built their own versions of it. The firms that once dismissed low-cost indexing as un-American or a formula for mediocrity spent the following decades launching their own index funds and exchange-traded funds, competing directly on the low fees Bogle had insisted from the start. The strategy that was once an industry punchline became an industry requirement. If you didn't offer a low-cost index option by the 2000s and 2010s, you risked losing customers to firms that did. Bogle himself never fully stepped away from being a critic. Even after winning the argument, he continued warning that the industry was drifting towards complexity and higher-cost products dressed up in index fund language, arguing that the original spirit of the idea, simplicity, low-cost, long-term ownership, was easy to lose sight of even inside the movement he had started. The lesson here isn't, index funds are good. That's a conclusion, but not the interesting part. The interesting part is how long a correct, well-documented idea can be openly mocked by an entire industry simply because it threatened how that industry made money. Bogle wasn't laughed at because his math was wrong. The math largely held up from the very beginning. He was laughed at because his idea reduced what an entire industry could charge for people doing something that it turned out wasn't worth as much as they'd been charging for it. That's worth remembering the next time an industry insists something is too simple to work. This video made you curious about what a low-cost index approach actually looks like in practice. That's a genuinely useful 5-minute rabbit hole. If you're looking for a simple place to start, I've placed some links in the description below to help you get started. As always, not financial advice, just financial history. See you next week.